Most foreign groups entering the UAE get the license, the office, and the first hires right. Then they face tax and compliance issues they did not expect. Finance and tax are almost always deferred. It feels logical. Sort the legal structure first, figure out compliance later. But a UAE subsidiary has real obligations from the moment it is incorporated. Not when it registers for VAT, not when it files its first corporate tax return, but from day one. And the decisions you make before incorporation, mainland versus free zone, legal form, and how the entity will transact with the parent, directly shape your tax position, access to reliefs, and compliance obligations. By the time most groups call a UAE tax advisor, much of that flexibility is already gone. There's one issue that catches foreign groups off guard more than most: management structure. Under UAE corporate tax, a foreign company can become UAE tax resident if it is effectively managed and controlled from the UAE. Practically, one common risk arises when the person running the UAE subsidiary is also directing other foreign group entities from here. That can create UAE tax residency risk for those entities without anyone intending it. This is not just governance, it is tax design, and it needs to be addressed before the structure is set. Once established, 4 areas need coordinated management from day one. First, tax compliance. Know the tax position early, what reliefs may apply, what the filing calendar looks like, and what records need to be in place to stay compliant. Second, accounting records. UAE tax laws, the Commercial Companies Law, and free zone regulations all require clean books. They are also the foundation for VAT, corporate tax, and management reporting. Third, intercompany transactions. Funding, management fees, and intragroup services must follow transfer pricing rules. Structure them deliberately, price them at arm's length, and document them before transactions begin. Fourth, reporting to head office. Head office needs timely management reporting and confidence that local compliance is under control. When books are late or intercompany balances are unexplained, local management stops running the business and starts answering questions. These failures rarely come from one major mistake. They build through gaps: no pre-incorporation advice, delayed registrations, unmanaged residency risk, intercompany arrangements entered into without proper agreements or planning, and bookkeeping, tax and reporting split across disconnected providers with no single point of accountability. That is what Audiix fixes. We work with foreign groups establishing UAE subsidiaries and with existing entities that need a more robust structure. We help put in place clean records from day one, coordinated VAT and corporate tax compliance, deliberate intercompany structuring, and management reporting that satisfies both local requirements and head office. We get involved as early as possible, ideally before incorporation, when structural decisions still have more flexibility. And we stay involved so nothing falls through the gaps. If you're setting up in the UAE or your existing entity needs a more robust structure, speak to Audiix. We'll help you put the right foundations in place from day one. Visit audix.com or click the link in the description to learn more.